Markets are officially open for trade, and the major averages are fractionally lower following the latest CPI report. Joining me now is Ben Emmons, founder and CIO at FedWatch Advisors. Ben, welcome to the New York Stock Exchange.
Thank you, Essie. Good morning.
All right, so what should we be taking away from today's CPI data?
Well, it was actually surprisingly a little softer than what normally a January report has shown last 4 years. That was a bit of a downside surprise for the markets in terms of the good thing, right? Yields were a bit lower, stocks a little higher, a lot of energy effect there and some shelter and some specifics. But by and large, an inflation report that at least shows like maybe we're going to continue softening from here, depending how energy plays out. So good news, I guess, because we had a good jobs report. Now we're getting a softer CPI report. So good news. Probably okay for the markets.
That's right. We are coming off of a hotter than expected jobs report that dropped on Wednesday. What should our viewers know about the state of the economy?
So it is a good economy. I don't think there's any weakness. We're seeing this tension in the markets on AI and people worried about disruption, but the economy itself doesn't show the disruption. Even the jobs report, which had all these revisions in there, which were very large last year, downward revisions, that has actually nothing to do with AI. It's actually just not much hiring because of probably the tariff uncertainty that weighs the most on companies' decisions, but also a labor market that's full employed, most of it. So you get this picture of like having an unemployment rate close to 4% and inflation near 2%, then you have an economy that's actually trucking quite well.
And what do this week's jobs numbers and today's CPI data mean for the Fed's rate cut timeline? How do you see them using this data?
They have a little bit of time now because in March you probably can skip it again because of where we are currently. There's not so much of a pressure about inflation is declining a lot more and the Fed should cut rates, otherwise they get too tight in policy, or this jobs report is weakening too quickly, therefore you have to act. These dynamics are not playing right now, so I think that keeps the Fed on hold in March. April we'll see, because that's always a bit further away. And we're still dealing with the overhang of how Powell will leave the Fed and that sort of thing. That does play a little bit of a role, why the market thinks that there will be only rate cuts after the new Fed chair comes in the committee. So I think the Fed's on hold for the time being.
All right, and the next Fed decision is still over a month away. What do you think is the biggest item that can influence that decision?
Well, I think we already actually had that biggest item, which is the labor market. I think if the unemployment rate had moved up a lot, I say 4.6 or 7, then it would be a really different situation. So at the same time, this Fed is also looking at like what's happening globally, what's happening elsewhere, because we have not just a good economy here, but there's strength elsewhere. And there's some still worry within the Fed that inflation may resurge again at some point. So far not playing out, but that's the worry. So I think the Fed's sort of sitting here on their hands saying, we just don't want to bring this rate down too far, even below the neutral rate, because that may overstimulate the economy.
What do you see for Fed rate cuts in 2026? Do you think we'll see one?
I'm actually still in the camp that it will probably be 2, but that's really based upon if the unemployment rate stays stable where it is and inflation does moderate from here, then there's a little room there to cut. Otherwise, there's not much more than that. So what the Fed has already been saying, they think they're closer to where the neutral rate is, which they think is somewhere around 3.5%, give or take. My guess is that that's where we end for the time being. The bigger question will be is that as the new Fed chair comes in with this hidden mandate, so to speak, as in, I got to bring rates lower, right? What will actually happen? Will this FOMC sway because of the political pressure? That's to be seen. But we'll see what plays out there. I don't believe that actually. I actually think this Fed will continue to stay focused on data, focus on a collegial, like a consensus decision making, which leads you then to just moderate rate cuts. So you can only think potentially 2, and that's it.
And AI has been causing some choppiness in the markets. Why do you feel that is?
So it's notable because we had actually Microsoft first with a bit of miss on the cloud earnings, and that's when it started. And people started looking at Microsoft as the bellwether of like you're the software, and what will AI do? Now we know that the post by Anthropic with Claude on how to use that as a basically a tool to automate taxes or automate other sort of functions or automate software functions that spark the anxiety. And I think what will then happen is you do have a lot of technical factors actually in the market of like, there's a lot of like these short-term momentum players that are, I think, playing these stocks really quickly and drive up the narrative. And now it has sort of started to spill over, right? We saw yesterday commercial real estate getting hit by it. Now the CBRE CEO, Solentic, did say like, well, if the labor force gets disrupted by AI, the demand for offices could change, could be negative. So there's something about this macro factor in the story. Is AI so disruptive to the labor market that it has these macroeconomic outcomes? I think that's what the market's trying to figure out. But I have to say that Treasury yields, they have declined, but I would have expected to decline them far more rapidly if there was a negative macro outcome from AI. I don't think that's the case. There's still much more spending and investment happening. It's just business models probably have to adjust. Like we saw in the 90s, we saw in the 2010s when new technology gets implemented.
All right. Thank you, Ben Emmons, founder and CIO at FedWatch Advisors, for joining us and for your insights.
You're very welcome.